When a man who manages over $100 billion and has spent 50 years studying the rise and fall of empires makes a move, the world of finance is compelled to listen. But when his moves appear contradictory, even paradoxical, we are forced not just to listen, but to think. Ray Dalio, the founder of Bridgewater Associates, is currently constructing a portfolio that on the surface defies conventional logic. He is simultaneously buying the ultimate safe haven, gold, and the ultimate geopolitical risk, China. He is betting on inflation with Treasury inflation-protected securities, or TIPS, while the Federal Reserve is waging its most aggressive war against it in a generation. This is not a collection of disparate trades. It is a unified, coherent strategy built on a singular, profound thesis. Dalio believes we are in the late stages of a long-term debt cycle, a dangerous period that mirrors the 1930s and 40s. He is not preparing for a simple recession or a market correction. He is preparing for a systemic crisis, a paradigm shift he anticipates will fully manifest between 2025 and 2028. What we are witnessing through his portfolio allocations is a meticulously crafted playbook for navigating the decline of one world order and the tumultuous birth of another. Today, we will deconstruct this playbook. We will explore the three pillars of his strategy: gold, China, and TIPS, and uncover why this billionaire investor believes these specific assets are the key to preserving wealth through the impending 2025-2028 crisis. This is not about market timing. It is about understanding the tectonic plates of history and finance as they grind beneath our feet. To truly comprehend Ray Dalio's recent maneuvers, one cannot simply look at a quarterly filing. You must first understand the intellectual framework he has built over a lifetime of study, a framework he detailed extensively in his book, Principles for Dealing with the Big Debt Crises. At the core of his worldview is the concept of the long-term debt cycle, a cycle that typically spans 50 to 75 years and governs the fates of nations and empires. He posits that these cycles have predictable patterns, and right now, the United States and much of the Western world are exhibiting all the classic symptoms of the cycle's final, most perilous phase. This phase begins when a country's debt levels become so immense that they can no longer be sustained through normal economic growth. The United States national debt has surged past $34 trillion. To put that number into perspective, the US debt to GDP ratio now stands at over 120%, a level not seen since the immediate aftermath of World War II. Historically, there are only a few ways out of such a debt trap, and none of them are pleasant. The first response, which we have witnessed for over a decade, is the lowering of interest rates to near zero. This makes the debt serviceable in the short term, but it fuels asset bubbles and encourages even more borrowing, exacerbating the underlying problem. When that tool is exhausted, central banks move to the next stage, quantitative easing, or as Dalio calls it, printing money. The massive stimulus packages unleashed during the 2008 financial crisis and the COVID-19 pandemic were classic late-cycle maneuvers designed to paper over deep structural cracks in the economy. This brings us to the present dilemma, the very trap that sets the stage for the 2025-2028 crisis. The money printing inevitably ignited inflation. In response, the Federal Reserve was forced to embark on a rapid and aggressive campaign of interest rate hikes. But this creates an impossible choice. If they raise rates high enough to truly crush inflation and restore sound money, the interest payments on the $34 trillion national debt would become catastrophically large. The Congressional Budget Office projects that by the end of this decade, net interest payments on the national debt will exceed defense spending, becoming one of the largest single items in the federal budget. This path leads toward a sovereign debt crisis, a default or brutal austerity that could trigger a deep depression. The alternative path is the one Dalio believes is far more likely. The Federal Reserve, under immense political pressure to avoid bankrupting the government and crashing the economy, will be forced to relent. They will have to tolerate a higher level of inflation and eventually pivot back toward a policy of monetary accommodation. They will, in essence, choose to devalue the currency to inflate away the real value of the debt. This is not a conspiracy theory. It is a historical constant. Throughout history, when faced with an insurmountable debt burden, governments have always chosen to debase their currency. This is the financial backdrop for the 2025-2028 crisis. But Dalio's model goes further, incorporating two other critical forces. The first is internal conflict. The same economic pressures that strain government finances also tear at the social fabric. The wealth gap widens, populism on both the left and right surges, and political polarization becomes extreme. The second is external conflict. The dominant debt-laden empire, in this case the United States, is challenged by a rising creditor power, in this case China. This creates geopolitical tension, trade wars, and the risk of military confrontation, further destabilizing the global system. When these three forces, the peak of the debt cycle, severe internal conflict, and the rise of a great power challenger, converge, the existing world order fractures. This convergence, this perfect storm, is what Ray Dalio's portfolio is designed to survive. And the period from 2025 to 2028 is the window in which he believes the storm will make landfall. Let's begin with the most ancient and perhaps most misunderstood asset in his arsenal, gold. Ray Dalio's affinity for gold is not a recent development. It is a foundational belief, famously summarized in his quote, "If you don't own gold, you know neither history nor economics." For Dalio, gold is not a commodity to be traded based on industrial demand or jewelry sales. It is money. More specifically, it is the only form of money that exists outside of any government's liability. It is a non-sovereign store of value. In the context of the 2025-2028 crisis scenario, gold's role becomes crystal clear. Remember the core of the crisis, an unsustainable government debt load that will likely be managed through currency debasement. When a government prints money to pay its bills, it fundamentally devalues every single unit of that currency. Your dollars, your euros, your yen, they all buy less. Savers and bondholders are quietly fleeced through the hidden tax of inflation. Gold is the ultimate antidote to this process. Its supply is finite, dictated by geology, not by the political whims of central bankers. As the denominator, fiat currency, is debased, the value of gold priced in that currency naturally rises. This is why central banks around the world, particularly those in the East looking to de-dollarize, have been accumulating physical gold at a historic pace. Data from the World Gold Council consistently shows that nations like China, Russia, Turkey, and India are systematically converting their dollar reserves into gold bullion. They are playing the same long game as Dalio. They understand that in a world where the primary reserve currency issuer is also the world's largest debtor, holding that currency in reserve carries an enormous unpriced risk. They are trading counterparty risk for the geological certainty of a physical asset. Bridgewater's 13F filings consistently show significant allocations to gold ETFs, such as the SPDR Gold Shares, GLD, and the iShares Gold Trust, IAU. This is not a speculative bet on the price of gold next month. It is a strategic, long-term insurance policy. It's a hedge against the very real possibility that the monetary system as we know it will undergo a fundamental reset during periods of negative real yields. That is, when inflation is higher than the interest rate you can earn on a government bond, cash and bonds become losing propositions. Their purchasing power erodes every single day. In such an environment, capital naturally flees to assets that can preserve purchasing power. Historically, gold has been the primary beneficiary of these capital flows. Dalio is not waiting for the crisis to hit. He is positioning his portfolio for the monetary environment he sees as an inevitable consequence of the debt supercycle. He is buying gold, not because he is a gold bug, but because he is a student of history, and history's lesson is unequivocal. When the printing press is run hot, hard assets provide the only reliable shelter. Now we pivot from the ultimate safe haven to what many perceive as the ultimate risk, China. This is, without question, the most contrarian and controversial pillar of Ray Dalio's strategy. At a time when headlines are dominated by fears of a Chinese real estate collapse, regulatory crackdowns on tech giants, and escalating geopolitical tensions with the United States, why would one of the world's most sophisticated investors be increasing his exposure to Chinese assets? The answer, once again, lies in Dalio's long-term, cyclical view of history. He is looking beyond the immediate noise and focusing on the underlying structural shifts in the global balance of power. Dalio's framework of changing world orders posits that for the last 500 years, global power has shifted from one dominant empire to the next in a predictable cycle. He identifies several key metrics of power: education, innovation and technology, competitiveness in trade, economic output, share of world trade, military strength, and the status of a country's currency as a reserve currency. By these metrics, he argues, the United States is in a period of relative decline, while China is in a period of relative ascent. Investing in China, therefore, is not merely a bet on a single country's stock market. It is a strategic hedge against the decline of the current US-centric world order. It is a diversification of geopolitical risk. From a purely financial perspective, the case is compelling, if uncomfortable for many Western investors. While the US stock market has been on a decade-long bull run, pushing valuations to historic highs, Chinese equities have been deeply depressed. They are, by many measures, cheap. Bridgewater's filings reveal holdings in broad Chinese market ETFs like the iShares MSCI China ETF, MCHI, as well as specific high-growth companies that are aligned with the Chinese government's long-term strategic goals, such as Pinduoduo. Dalio is buying assets that are out of favor and undervalued, a classic principle of long-term value investing. Furthermore, he sees the development of China's capital markets and the internationalization of the yuan as an inexorable trend. While the dollar's dominance is not ending tomorrow, China is actively laying the groundwork to challenge it. Initiatives like the digital yuan, the creation of alternative payment systems to SWIFT, and settling an increasing amount of trade in its own currency are all strategic moves to reduce its dependence on the US-controlled financial system. For an investor like Dalio, having exposure to the currency and the assets of the rising power is a crucial component of a truly diversified, all-weather portfolio. It is the other side of the coin to owning gold. Gold protects against the debasement of the current system. An allocation to China provides exposure to the system that may eventually succeed it. Of course, Dalio is not blind to the risks. He has spoken at length about the challenges of investing in a state-controlled capitalist system and the ever-present danger of geopolitical conflict. However, his calculation is that the risk of not being invested in the world's second-largest economy and fastest-growing major power is even greater, especially for a portfolio with a multi-decade time horizon. In the context of the 2025-2028 crisis, an allocation to China serves as a powerful diversifier. If the United States enters a period of stagflation and political paralysis driven by its debt crisis, a non-correlated engine of growth becomes incredibly valuable. It is a bold, contrarian, and historically informed bet that the center of global economic gravity is slowly but surely shifting eastward. The third and final pillar of Dalio's crisis-era portfolio is perhaps the most technical, yet it is a direct and surgical response to the specific mechanics of the debt crisis he foresees. This asset class is Treasury Inflation-Protected Securities, or TIPS. To understand why Dalio favors TIPS, you must first grasp a concept known as financial repression. This is what governments do when they are trapped by debt. Financial repression is a quiet, often subtle set of policies designed to channel funds to the government and reduce the real value of its debt. One of its primary tools is to hold interest rates below the rate of inflation. Imagine this scenario, the one Dalio anticipates for the 2025-2028 period. The US government needs to roll over trillions of dollars in debt. The Federal Reserve, unable to raise rates for fear of causing a fiscal crisis, keeps the federal funds rate at, say, 3%. However, due to ongoing deficits and supply chain issues, actual inflation is running at 5%. In this environment, if you own a standard 10-year Treasury bond yielding 3%, you are losing 2% of your purchasing power every single year. You are being repressed. Your savings are being systematically transferred to the government to lighten its debt burden. This is where TIPS become essential. A TIPS bond is a unique government security. Like a conventional bond, it pays a fixed coupon. However, its principal value, the amount you get back at maturity, is adjusted semi-annually based on changes in the Consumer Price Index, CPI. If inflation rises, the principal value of your TIPS holding increases. Consequently, the dollar amount of your coupon payments also rises, as they are calculated based on the inflation-adjusted principal. In short, TIPS are designed to provide a direct contractual hedge against inflation. They are an insurance policy against the very act of currency debasement that Dalio sees as the inevitable outcome of the debt supercycle. When you look at Bridgewater's strategic allocations, their models heavily favor inflation-linked bonds over nominal bonds in the kind of economic environment they forecast. Why? Because nominal bonds get crushed by unexpected inflation. TIPS, on the other hand, are designed to thrive in it. Buying TIPS is a direct bet that the Federal Reserve will ultimately choose to prioritize fiscal stability over price stability. It is a bet that they will allow inflation to run hotter than their stated 2% target to help the US Treasury manage its debt. In the world of 2025 to 2028, where financial repression could become official, unofficial policy, holding nominal bonds would be a surefire way to lose wealth. Holding TIPS provides a vital layer of protection. It's important to note that TIPS are not a perfect asset. Their market price can still fluctuate based on changes in real interest rates, the yield on a bond after accounting for inflation. If real rates rise, the price of existing TIPS can fall. However, their unique structure provides a baseline of inflation protection that no other sovereign bond can offer. They are a specific tool for a specific problem. That problem is the erosion of purchasing power via government policy. By combining the timeless protection of gold, the geopolitical diversification of China, and the explicit inflation hedge of TIPS, Ray Dalio is not just building a portfolio. He is constructing an ark designed to carry wealth safely through the coming deluge. So what are we to make of this seemingly disparate collection of assets? Gold, the relic of history. China, the geopolitical adversary. And TIPS, the arcane government bond. Together they form a deeply coherent and powerful message about the future of the global economy. Ray Dalio is not making a simple call on inflation or interest rates. He is making a structural call on the end of a paradigm. The post-World War II, dollar-centric world order, which has been the bedrock of global finance for nearly 80 years, is fracturing under the immense weight of debt. The period between 2025 and 2028 represents, in his view, a critical window where these long simmering pressures are likely to boil over into an acute crisis. Let's synthesize the strategy. Gold is the foundational hedge. It is the asset you own when you lose faith in the ability and willingness of governments to maintain the value of their currency. It is a bet against the entire fiat money system, a system that is being stretched to its breaking point by the demands of sovereign debt. China is the diversification hedge. It is an acknowledgement that the world is no longer unipolar. The United States, while still the dominant power, is facing a credible economic and strategic challenger for the first time in decades. Holding assets in both camps is a pragmatic recognition of this new multipolar reality. It hedges against the risk of being over-concentrated in a declining empire and provides exposure to the potential growth of its successor. Finally, TIPS are the policy hedge. They are the direct countermeasure to financial repression, the most likely policy toolkit governments will employ to manage the debt crisis. While others are holding nominal bonds that will be systematically devalued by inflation, an allocation to TIPS provides a shield, preserving purchasing power in a world where governments are actively trying to erode it. For the professional investor, the implications are profound. This strategy is a direct challenge to the conventional wisdom that has dominated portfolio management for the last 40 years, particularly the traditional 60-40 stock and bond portfolio. In the inflationary, volatile, and geopolitically fraught environment Dalio envisions for 2025-2028, that model is dangerously inadequate. A 60-40 portfolio is effectively a single bet on continued disinflationary growth and geopolitical stability, the very conditions Dalio believes are coming to an end. The actionable insight here is not to blindly copy Bridgewater's portfolio. The insight is to adopt their framework of thinking. It is to stress test your own portfolio against a future that may look radically different from the recent past. Ask yourself, how does my portfolio perform if inflation remains structurally higher for the next decade? How resilient is it to a major geopolitical shock involving the US and China? What happens to my assets if faith in the US dollar as the world's primary reserve asset begins to seriously erode? The 2025-2028 crisis that Ray Dalio is preparing for is not a certainty, but it is a historically grounded probability. It is the logical endpoint of decades of accumulating debt and deferring difficult choices. By analyzing his moves, by understanding the deep logic behind his allocation to gold, China, and tips, we are given a map. It is a map of a turbulent and uncertain future, but one that is not without pathways to navigate it. The time to prepare is not when the storm makes landfall, but now, while the skies, though darkening, are still relatively calm.